So when it comes to your philosophy on credit, because everybody has a different philosophy. You got all these credit gurus, all these credit, self-proclaimed experts. What would you say your philosophy on credit is, and what kind of sets it apart, and why do you feel like it's more true?
Well, I don't consider myself to be in competition of different credit specialists, but the simplicity of my concept is that my philosophy of credit is that your credit is what it takes to actually get, or the lack thereof will determine on whether you get through this door financially or not. And so your score is dependent on either how high that score is or how low that score is will determine on whether you are approved for credit. So my philosophy is to first know your score. And it is knowing what your status is. Just as the medical community has made it so important to know your status as it relates to your health, you also need to know your status as it relates to your finances and as it relates to your credit. And you have to know, you should, in the forefront of your mind, if someone called you now and asked you, what was your credit score, you should know. You may not know exactly, but you should know what range you're in. And so I think it is absolutely essential to know what your credit score is.
Gotcha. And speaking about that, with it, even though it's so basic, what is a credit score?
So a credit score is a 3-digit number that determines your financial risks to creditors. And that 3-digit score tells them whether you are likely to pay and to pay on time, or whether you are likely to default on any potential loans that they will give you. And so that score can range anywhere from the low 300 is the bottom, and all the way to an 850 FICO credit score. And so the key is obviously to get your score up as high as it can possibly go into that excellent credit range.
So speaking about the credit score, let's talk about the actual credit bureaus and what they are and what they represent. Right?
So the biggest misconception is, first, the 3 credit reporting agencies are Equifax, Experian, and TransUnion.
Right.
All 3 are equal. So there is no one Equifax is more important than TransUnion or Experian. They all are equal. The misconception is that they sort of like hold or can determine things for you or against you. The way to actually look at the credit reporting agencies is that they store credit information, and they are just simply a neutral party that stores information regarding you. Data furnishers, which are your creditors, give them information to post as it relates to you. If you disagree with that, you can then challenge the credit reporting agencies which are reporting that, and the Fair Credit Reporting Act mandates that whatever they're reporting has to be accurate. And so you can challenge it with them and make sure that, and hold their feet to the fire literally, to make sure that what they are reporting about you is accurate.
So when it comes to building credit, right, what are some of the basic things, and then we can go a little bit in depth too, but what are some of the basic things that somebody can do to actually start building their credit profile? And for one, I want to talk about somebody who has no credit, and I also want to talk about somebody who has bad credit and they're trying to figure out how to build a credit profile. What would you, or how would you explain it to each one?
So let's say first the one who has bad credit. So I think that just because you have bad credit, it doesn't mean that you should do nothing until you the bad credit is either fallen off or you have successfully removed them off. But you should be proactive in that if something is reported negative in your credit report, then you need to find a way to point to put 2 more things that are positive into your credit report. One of the ways of doing that is all banks and all financial institutions offer secured loans, secured credit cards. And it does not matter what your credit score is or what your credit rating is, you can use your own money to do what's essentially buying your own credit. And so if you take out a $1,000 loan with a financial institution, like say Bank of America, and Bank of America offers secured loans, and you put $1,000 of your own money into that account, you don't have to qualify as other people would with an unsecured loan because your money qualifies you. And so that $1,000 will sit in a certificate of deposit account. And as you are paying it off, then once you pay that off, well, as you're paying it off, it's reporting as on-time payments. And those on-time payments are building your scores up. And then once you have paid off that account, then the bank then returns you your $1,000 that you originally put in. Likewise, with credit cards, you can put as little as $300 and as much as $5,000 in on a secured credit card, regardless of whether you have good credit or not. And even though you have bad credit, and you can put that onto a secured credit card, and as you're making on-time payments, then you're building up your credit. And so eventually, the good will outweigh the bad. Now, most people will see that and say, so I'll just get myself one secured credit card, and then I'll gradually build my credit. But for the person who is wise, they would say, maybe I'll just get myself 10 secured credit cards, and I will then make on-time payments and invest in putting 10 secured credit cards on my credit report and putting 10 new trade lines into my credit report and report them accurately. And as I am building, the person who has the 10 credit cards into their credit report is building their credit 10 times faster than the person who has one. So my advice is that there should always be a strategy attached to the way you're building your credit. And you don't just go after your credit haphazardly. You build it with a strategy in mind. So if you're planning to get this house, what is your strategy? So your strategy can't just be, I'm going to remove this and then I'm just going to apply in the dark. You have to have a strategy. Long before you sit down with the real estate agent, you need a strategy.
How do you feel about these consumer credit companies that, you can get extended like a $5,000 line of credit instantly, like a My Jewelers Club, like a New Coast Direct? How do you feel about those?
Well, they're good. So anytime you can put positive accounts into your credit report, some of them will allow you to put backdated history into your credit report. That's always good to have. And that is a primary account. So an account that basically is in your name, that you are the responsible for. And so that's a good account to have in your credit report. And it's something good to have. And you need to add as many positive trade lines as you can possibly add into your credit reports.
And we spoke about bad credit. What would you consider bad credit?
So it is not necessarily what I consider bad credit, but what the FICO credit score considers bad credit. And that is a credit score that is in the low 500s and lower, then that is considered poor credit. And so if you have poor credit, it means that most lenders, if not all lenders, are not going to give you anything. So you are a risk to all of them. And so it says that you have defaulted on something or multiple accounts that are in your credit report, and that you cannot be trusted with credit.
So would you say that it's a myth that you can have a couple collection accounts and then you have a credit score in the mid 600s? Somebody would call that bad credit, right? I know people who would call that bad credit. But does having two collection accounts necessarily prevent somebody from going and acquiring assets, or from going and acquiring a loan, or from acquiring, a phone or jewelry?
So it depends.
Right.
It's about the totality of the credit report.
Right.
So a person can have two collection accounts in their credit report, but if they have 20 other positive accounts in their credit report, then the creditor is not really going to pay as much attention to those two collection accounts. But if a person has 3 or 4 accounts and they have two, and 2 of them are collection accounts, then that's a major signal to creditors is that this person is more likely to default on this account. And a collection account is just not a collection account. It means that the original creditor has sold that debt to a collection agency who has bought it, and that account had to go to charge-off status, and that means that they pursued you, the original creditor pursued you for months, and you defaulted on for months at a time and did not make on-time payments. An account usually doesn't go to charge-off status until about the 3rd or 4th month of missed payments, and then the creditor will sell it off as a charge-off account. So, and then the collection agency buys it at pennies on the dollar, and so now that account is sitting in your credit report as a collection account, and so new creditors understand that, and that literally they may have to, if you're applying for an account with them, they may have to be in that same situation that you were in with your other creditors, and you not paying that bill, and they may have to sell the account that you're applying for right now to a collection agency in the future. So you have to be concerned with how you so I say that your credit report is basically your financial resume. And so you are responsible for how you show yourself to the world. So if your a resume is someone who's seeking employment and they want to put themselves in the best light, so you're not going to tell that, I may have gotten fired from this job or fired from this in the past. You're going to eliminate some information and then put as much favorable information as you can into your resume. So likewise, it is with your credit report. That is your financial resume. And for your creditors, future creditors, they are looking at that resume or that credit report, and it is your financial resume, and they're learning things about you, and they're learning about your credibility. So that's where the root word credit is from. It's your credibility. So whether you have the financial credibility for me to be able to give you this loan, and so because your credit report is a reflection of you, you have to put as much positive into that credit report, and you have to really position yourself to understand that I'm not just sitting here and talking to this creditor. I need to position myself on the other side, and then see my credit report from your side. And say, would I give you credit if I was sitting on the other side of the desk? And so you have to proactively go and get yourself a strategy and find someone to help you with the strategy to make sure that you get everything and that your credit report reads in a favorable manner that you can apply for anything that you want and successfully receive it.
Beautiful. So we just talked about building credit for somebody with bad credit, right? How they can start building their credit profile. But what about somebody with no credit? How do they start building their credit profile?
Okay. So if a person has no credit, first, a creditor doesn't know how to, cannot do an evaluation on you if you have no credit. For the person who has no credit, good or bad, then they basically have a 0 credit score. And so with a 0 credit score, I just recently had a client who was trying to purchase a car, and they would not finance him because he had a 0 credit score. They said that they could even get him financed if he had a negative credit score, but they cannot finance him with a 0 credit score because he doesn't have anything in it. So my advice is, first, because the creditor doesn't know you, you basically are a blank sheet of paper to a creditor. And so my advice is, before you ever apply for anything that is unsecured, then you need to find ways to put all kinds of positive stuff into your credit report, whether it's secured credit cards, secured loans, authorized user accounts, and put those things into your account, into your credit report, so that you can generate a credit score, and so that the creditors will have something at least to go on and in deciding on whether to give you credit. Now, if you are 18 to 25 and you have nothing in your credit score, it's almost acceptable because you can be young. So all of the major car dealerships will have these first-time buyers plans for youngsters who are college students or whatever. And it's your first time buying a car, so they understand that you may not have any credit history. But if you're over 25 and you don't have anything in your credit report, that is unacceptable to creditors. And they're saying, well, either you are living under a rock, you don't have employment, or you don't have something is going on that you have dropped off out of society.
And they don't want any part of it.
And so they want no part of you because they don't know how you pay your bills or whether you will ever show up, or whether you go back to not having any credit and living the rest of the next 25 years of your life without credit. So they don't want to deal with you at all.
Gotcha. Now, one of the things that can become predatory when it comes to credit are interest rates, right? So I've seen, especially when it comes to people getting lines of credit, I've seen interest rates go from 29% to 35%, and I've heard of interest rates even going as high as 65%, which is crazy. So what would you say are some things to look out for when it comes to interest rates, and kind of just getting a good understanding about interest rates as it affects credit, or as it has to do with credit?
The higher your credit score, the lower your interest rate.
Right.
And so the focus should be on your credit score.
Yeah.
And the focus should be on building your credit. There are predatory lenders and that will target you and that target poor people simply because of their credit scores. And so they want people with bad credit to give them lines of credit so that they can charge them this outrageous amount of interest rate on those loans and get them to pay back tremendous amounts of money for small amounts of loans. And so you have to be aware of that, and that there are companies that are not out to help you, but they're out to help themselves on the back of you because you have not educated yourself with your credit. And so my advice is that before you go applying for anything, you need to make sure that you know first what you qualify for, and then you need to build your credit high enough so that you can go in and get it at the best interest rate that you possibly can. Doesn't mean that you can't, that you won't. You may get a car that you may get it financed at 10, 12% and an interest rate, but you should be proactive with that and saying that, okay, this is what I had to do, but 6 months from now, I'm gonna refinance this. I'm gonna build my credit score up, and I'm gonna refinance this car, and I'm gonna get in at a much lower interest rate. And so there has to be a strategy attached, that you just can't go through life being a victim. You got to educate yourself, and so that you know what you qualify for and what you can do.
So what's that score what's the goal as a score? Is it the 720? I hear 720 is the same as the 850. So what's the, you got people say minimum 680 FICO score. What's the actual score?
So the scores go into different ranges. So a 659 to a 749 is considered good credit. And that is what good credit is according to the FICO credit score. 90% of all creditors and lenders go by the FICO credit score. So pay no attention to if you go on Credit Karma and you get your credit
FICO?
score.
Excuse me, what's FICO for those that don't know?
FICO is the Fair Isaac Corporation. And the Fair Isaac Corporation, Fair and Isaac were two guys who came up with this credit calculation system that determines what your risk factor is. And while nobody knows all of the technicals of what goes into this system that they have developed, it is the system that 90% of all creditors use. And so you have to know what your FICO credit score is before you apply for anything, before you go into that dealership. You cannot just get drawn in because you saw something through the showroom floor and you had to go make a U-turn and go back. My advice is pull your credit score and go before you ever pull into that lot so that you know what you qualify for, so that you don't become a victim of having your score drop even lower when they run your credit score and get you about 30 more hard inquiries into it and take your score down even further. So you have to be proactive in knowing what your credit scores are, your real FICO credit scores are, and then making calculated, educated decisions regarding how you apply for credit.
That brings up a great segue into credit monitoring, because I know a lot of people, they monitor their credit with creditkarma.com, which goes by a whole different model than the actual FICO score. Can you actually explain what's the best credit monitoring in your?
So let's say what Credit Karma isn't. Right. So Credit Karma is, they give you first, they only give you your Equifax and your TransUnion. So they don't give you your Experian credit score or credit report. And the credit reports that they give you are not like a full, complete credit report.
Okay.
So, but Credit Karma is good because they will alert you much faster than a lot of other monitoring systems. They update itself every 7 days. But the credit score is not a real FICO credit score. It's called an educated score.
Right.
And an educated score is another way of saying an educated guess of what your score could be. And so your FICO credit score is always about maybe 20, 30 points above what you would see on Credit Karma.
Wow.
So you could get depressed over something that you saw, your score on what you saw on Credit Karma, and talk yourself out of a situation because you didn't actually pull your real FICO credit score and realize that you actually did qualify for that. So that's what it isn't. My advice is that if you're going to go with a monitoring system, go with one of the 3 credit reporting agencies. Equifax, Experian, and TransUnion each offer credit monitoring on a monthly basis, and you pay for one fee, and they give you all 3 credit reports, so you don't have to pay for each one of them. You pay one fee with Experian, and you get your Equifax and your TransUnion credit scores as well, and credit reports as well.
And I do understand too that it's different types of FICO scores, right? So you can pull your Experian credit report and you can see it says a 650, but you go to your mortgage lender and then they pull your credit report and then it's like a 598. So what's the?
Yeah, so it's different scores for different things.
Right.
So there is a FICO credit score that's general, what your general score is, but there is a FICO credit score for if you're applying for credit cards, and what your score would be if you were applying for credit cards. So, for example, American Express goes with your with Experian. So when you apply for American Express card, they go with your Experian FICO credit score, and they pull it from Experian. So you want to know what that credit card score is with Experian, because it will tell you exactly what you qualify for and what you don't qualify for with it. But they also have one for mortgages. They also have one for auto loans, and you need to be aware that those scores are different. So your main score may be one thing, but for a car, your score may not be high enough. It may be high enough for in general, but it may not be high enough, and you get to the dealership and say, but I pulled my score, and my score is this. But yeah, that's your general score. That's not for auto. So you gotta know everything.
Gotcha.